Welcome to the deep dive. Ever wonder, how much a country really leans on the rest of the world just to get by?
It's a great question.
Today, we're sort of cracking open this interesting economic snapshot.
Yeah.
Imported goods as a share of GDP, gross domestic product.
Right. The total economic pie a country bakes each year.
Exactly. And we're looking at the slice of that pie that's, well, actually made up of goods brought in from outside its borders.
hmm
Our mission today is pretty straightforward. Let's quickly get a handle on what a high or low import share tells us about an economy.
And look at some real examples to make it clearer.
Yeah, make it stick. So this ratio, imports divided by GDP, it gives us a lens into an economy's structure and maybe its weak spots.
Precisely. It's about how much demand for actual stuff, tangible goods, is met by home production versus, buying from abroad.
Okay, so let's start there. A high percentage. Lots of imports compared to the overall economy. What story is that telling us?
Well, often it signals a significant reliance on the global market. If you're not making enough yourself to meet demand,
You got to buy it elsewhere. Makes sense.
you have to import more, yeah. But dependency, it can carry some risks.
Risks, like what? Let's dig in a bit.
Okay, well, the most obvious one is being vulnerable to supply chain disruptions.
Mhm.
Geopolitical stuff, natural disasters, pandemics.
We've definitely seen that lately.
Absolutely. Any of those can just jam up the works. And if you rely heavily on imports, that means shortages, it means price hikes.
Right. Your supply line stretches across the world. Any break causes trouble at home. Got it. What else?
Often, a high import share goes hand in hand with trade deficits, meaning you're buying more than you're selling.
Okay.
And long term, that can put pressure on your currency, maybe cause some macroeconomic imbalances.
Mhm.
And another thing sometimes, constant exposure to cheaper imports can make it tough for your own domestic industries to grow and compete.
Because they're up against potentially much lower prices from overseas.
Exactly. It can be a real challenge.
Okay, so high import share, greater need for trade, but also potential exposure to global hiccups, maybe impacts on domestic industry. Let's flip it.
Right.
What if a country has a really low percentage?
Mm,
Low imports relative to GDP. That sounds good, right? Like a sign of strength.
it often is, yeah. A low share can point to a pretty robust, diverse domestic production base. The country can mostly provide for itself.
Or maybe it's a big exporter.
That too could indicate an export-driven economy that sells a lot, so it doesn't need to import as much in relative terms.
But I'm sensing a but coming here. Is there a downside to a very low share?
There can be, yes. An extremely low share might not just be self-reliance. It could be down to protectionist trade policies.
Like high tariffs, quotas, that kind of thing.
Precisely. And while that might shield domestic industries, it can also limit consumer choice, maybe drive up prices.
And less competition could mean less pressure to innovate at home.
Exactly. It can potentially reduce overall economic efficiency by sort of walling off domestic producers from international competition and ideas.
So it feels like there's a balance to be struck, some kind of sweet spot maybe. Is there like an agreed upon ideal level for this import share?
No, not really. There's no universal ideal. It's very, very contextual.
Depends on the country.
Totally. Depends on their resources, their technology, market size, their trade strategy, all sorts of things. Policymakers are always trying to balance the benefits of trade, variety, lower prices, with the need for resilience and security.
Okay, let's get concrete. How does this look around the world, say right now in 2024? Goods imports as a percentage of nominal GDP.
Yeah, looking at the numbers, you see some interesting patterns. The EU and Mexico, for instance, both have relatively high shares, around 35%.
35%, wow.
And South Korea is not far off, about 34%.
So even very developed places like the EU and South Korea can have high import dependency.
Right. It shows a high share isn't automatically a sign of, economic weakness. It depends why. For the EU, it's partly trade between members, plus reliance on outside energy and electronics.
Then Mexico.
Strong ties to the U.S., especially in farming and the auto sector, that integration drives up the numbers.
And South Korea. Big manufacturer, but still needs imports.
Yep. Needs to import a lot of essentials, particularly food and energy.
Okay. What about some others? Canada, UK, Japan?
Canada's around 26%, the UK is about 23%, Japan's lower at 18%. Still, significant engagement with global trade,
What kind of things?
Well, Canada imports vehicles, machinery, electronics. Japan relies on imports for energy, raw materials, key components like semiconductors.
Gotcha. Now the big ones, US and China.
Interestingly, they're both relatively lower. The U.S. is around 12%, China about 14%.
Lower, despite being huge economies.
Yeah, partly because their domestic markets are so massive, but the reasons behind the low share differ a bit.
How so?
The U.S. has a lot of its own resources. It's actually a net exporter of food and energy. China, on the other hand, has made a very strategic, deliberate effort to build up its own domestic production across many industries.
So, two different paths to a similar-looking outcome there.
Fascinating. Have these levels changed much over time, say since 2000?
Somewhat. Both the US and the EU have actually become more reliant on China for specific things: machinery, electronics, textiles, furniture. That dependency has grown.
But China itself.
China's overall import dependency, if you exclude primary stuff like raw materials, has stayed relatively stable, which suggests their push for domestic production and diversifying where they buy from has been, well, pretty successful.
Okay, so we see this whole range. What are the key drivers then? What pushes a country towards higher or lower import dependency?
Well, economically, the size and diversity of the home market is huge. Bigger, more diverse economies can often do more themselves.
Right.
Level of development matters too. Specialization, what a country is good at making versus what it's better off buying. And, of course, natural resources. If you don't have oil, you probably import it.
Makes sense. What about non-economic factors? Geography, politics. Yeah, geography plays a role. Being close to trading partners helps. Smaller countries might just physically not be able to produce everything.
And politics. Trade deals.
Absolutely. Trade policies are critical. Tariffs, quotas, free trade agreements like the USMCA, they directly shape import flows. Political stability matters too.
Even culture, like consumer tastes.
Sure, preferences for foreign brands can nudge imports up. So you mentioned USMCA. That must be a big part of Mexico's 35%, right? That integration with the U.S.?
Definitely. Agreements like that create really deep supply chain links, especially cars, agriculture, lots of goods flowing back and forth, drives up Mexico's number.
Okay, that paints a clearer picture. Let's just quickly revisit those examples. Mexico, South Korea, U.S., China.
Yeah, like Mexico, 35%, driven by U.S. ties via USMCA.
Yep. South Korea, 34% needs food and energy imports despite strong manufacturing.
U.S., 12%, large, diverse economy, lots of resources.
In China, 14% strategic focus on building domestic capacity.
Got it. These examples really help. Now, thinking hypothetically, what if there's another big global supply chain shock? How do different levels of dependency play out?
Well, high dependency countries would likely face pretty immediate problems. Think the EU scrambling for electronics or Mexican car factories slowing down, waiting for parts.
Whereas lower dependency countries might weather the storm a bit better.
Potentially, yeah. More resilience to those external shocks. Or think about, say, a big breakthrough in renewable energy tech.
Okay.
Countries that import a lot of fossil fuels, like South Korea, could see their import share drop significantly over time if they adopt it.
Interesting. And trade wars. Tariff.
If major tariffs go up, high importers from those regions face rising costs. That could hit consumers, businesses, investment. So yeah, vulnerability to shocks is a key risk with high dependency.
We've certainly seen that play out.
Yeah.
Okay, last thing, let's connect this briefly to everyday stuff. Electronics, cars. Say in India, the US, Europe.
Sure. Electronics, all three regions consume a lot, right? So that suggests significant import reliance, though the levels vary. Even with India boosting its own production and the U.S. importing from India, imports are key.
And cars.
While India has lower car ownership than the U.S. or Europe currently, so that might mean a lower share of imports related specifically to vehicles. But EVs are changing the game everywhere, which could shift import needs for batteries, components.
Right, and energy, fossil fuels.
Big differences there. Depends on domestic production, how much people use per person. That directly feeds into the overall import dependency figure we've been talking about.
So this one number, imported goods as a share of GDP, it actually gives us a pretty powerful, quick snapshot.
It really does. Shows how interconnected an economy is, highlights potential strengths, potential vulnerabilities.
But crucially, there's no single right number.
Exactly, no magic bullet. The right level is always shifting depending on resources, economy, policy choices. It's complex.
Okay, so here's something to think about. With global trade constantly being reshaped geopolitics, new tech car, what might these import dependency figures look like in, say, 10 years?
Good question.
And what kinds of strategic choices do nations need to make now to navigate that future and make sure their economies are secure and doing well?
Lots to consider there.
Definitely food for thought. Thanks for taking this deep dive with us.